Have you ever wondered how professional trading looks like? In this video, I will reveal the DR trading strategy that I supercharged with over 120 million data points and unmatched precision in time and price entry. This should literally be hidden to the public. Let's get started with the top 7 trades from last week. Number 7, light crude oil futures market, Tuesday overnight DR session trade with Quant X data. Right here we have the overnight DR session in crude oil with a short confirmation at 4 a.m. and I will show you a classic high probability time and price trading setup that I teach to my students. It perfectly illustrates why data is important and how you can use it to your advantage for the best possible outcome of your trading. With that being said, let's switch over to the Quant X database where we work with more than 120 million data points. I want you to see what a basic time and price trade looks like with the DR trading strategy, and there's literally nothing in the retail space coming close to this. We select the asset, the session, the day, the direction of the confirmation. We assume that we will get a DR true session. The confirmation happened between 4 and 4:15 a.m. and if you want, you can also select the color of the box. For this demonstration, we will only look at the retracement time, maximum retracement, and the extension distribution. Let's start with the retracement time, where we can see that most of the retracements happened in the first hour after the ODR box has formed, and at 5 a.m. we can expect 50% of retracements to be done. For time and price, we ideally want to enter from the beginning of the mode, which is the highest one here, up until the median time of max retracement. This is where the magic happens. We select this exact time window and cross-filter the data only for that specific time to see what has happened historically there. As you can see, the data has changed to this selection now. Next, we want to identify the highest probability retracement area in that time window measured in standard deviations. There are 2 perfect retracement clusters that should be on your chart, which also include the modes. 70% of the maximum retracement should be done at -0.6. Everything else to the left we can keep in our head, as it also marks the retirement setup area. Now the only thing that's left for a possible time and price trade is a high probability target. One standard deviation has been reached 85.7% of the time. Let's go with the 1.7 to 1.8 standard deviation level that has been reached 69% historically. Going back and applying everything to the chart, it would be looking like this right here. The yellow range represents the time window where most of retracements have happened. The red boxes represent the highest probability retracement levels, and to the downside we have high probability targets for the session. Almost at the end of the high probability retracement time window, this happens. Price is touching the second high probability price cluster, and we're almost at the time where 50% of retracements should be done. Some of my students are already confident enough to snipe those entries, but let's assume you enter with the close of the candle here. That's a potential of 4.3 R, and as an extra confluence you also have a beautiful intraday gap imbalance lining up, which has been rejected to the tick. At 5 a.m. more than 50% of retracements are done. We can assume with more than 50% that this high right here is the highest retracement if the session holds true. At the end of the session, price reached even more standard deviations. I hope you finally understand how powerful and necessary it is to include historical data into your trading. This mechanical trading approach is just one of many that I teach, and by just using time and price after backtesting it long enough, I can guarantee you that you will be profitable. Data doesn't lie. Number 6. Bitcoin versus the US dollar, Thursday regular DR session trade. Bitcoin had a really nice regular DR session on Thursday. At 11 a.m. price closes below the defining range on a 5-minute time frame and confirms shorts with a higher probability for the session. With the confirmation candle, price already reached the 0.5 standard deviation level, where we already know that we either want to target a new low after a retracement or the next standard deviation level of 1. Price returns back into the defining range and rejects the IDR low 3 times and also closes back below the DR again. A quick look at the Bitcoin futures chart is recommended just to confirm the price action. The optimal setup with the stop above the opening price would reward you with less than 3 R, so you would have to move on and skip the trade. Later in the session at around 2 p.m., price starts to reject the IDR low several times, But what's more impressive is that in the Bitcoin futures price chart, it rejects the opening price. Coming to the last hour of the session, you definitely want to see a close below the range to become a DR true day. With all those rejections from the opening price, this can be your setup here, targeting a new low or close the position at the end of the session at 4 p.m. Number 5. Euro versus the US dollar, Monday aftermarket DR session trade. Monday's aftermarket DR session in Euro closed as a green DR box, and with the next candle, price confirmed longs with a higher probability for the session. Price retraces back into the defining range below the IDR mid, then comes close to the opening price and closes back above the mid again. Let's see what the currency's futures chart is doing at the exact moment for better insights. The picture here gets even clearer. Price clearly fails to close below the opening price and shows not only wick but also body rejections. Below the current price action, there are also volume and gap imbalances, and to the upside, a nice open magnetic volume imbalance that's not been rebalanced by price yet, and another one above 2 standard deviations. Let's focus on the first one right above these highs here, and for that we go back to the spot market price chart. With the close of this candle and the stop below the opening price, which also covers the beginning of the retirement setup area, you get a potential 4R. Unfortunately, price didn't make a new high and retraced all the way back below the initial stop loss. That should be a break-even trade for you here if you manage risk accordingly. Now we have price in the retirement setup area and can use our second bullet for the session. Let's check the futures chart one more time if something lines up as well. There is the gap imbalance from the ADR box forming and a volume imbalance lining up. It should act as a no trespassing area here in line with the green DR box and long confirmation. Otherwise, it's very likely to get a false DR session, make or break area. This setup offers almost 5R and is definitely, with all the confluences stacking up, worth taking the risk. The immediate close back above the opening price is a good sign, and price finds its way to the target. Excellent example of a retirement setup trade with more than enough extra confluences to take a trade. Join me as I teach thousands of students how to trade like a professional. Learn how to trade the DR trading strategy combined with data, get access to exclusive tools and indicators, weekly live trading sessions where you also get deep market insights, which have never been taught in the retail space before, and a lot more. Visit m7dr.com for more information. Number 4. S&P 500 futures market, Tuesday. Regular DR session trade with a little bonus. This trade right here can't get any better. ES formed a big red DR box with almost 40 points to the downside. Right after that, it confirmed shorts with the 10:30 a.m. candle. The earlier, the better. What's also important to notice is that there are no open magnetic volume imbalances inside the defining range. Price drops lower and retraces back to the low of the range. Now here is the most crucial thing. When zooming out and going back to previous week's price action, there is a daily gap imbalance from Wednesday going into Thursday that's been broken to the downside for the first time at current price action. What more confluences do you need? That is more than just a high probability setup. Small bonus right here for your notes. If you get a DR short confirmation at 10:30 a.m. on a Tuesday in the regular DR session, you can expect 50% of all retracements to be done at 12:15 p.m. if the session holds true. Most of the retracements happened within the first hour after the box has formed until 11:30 a.m. Now, if you manage to enter in this time period up until 12:15 p.m., you can cross-filter only for that time and see what has happened in the past. Focusing on the retracement areas, we can see that most of the retracements in the past happened at 0 to plus 0.1 and 0 to minus 0.1. Around 70% of retracements reach the minus 0.3 retracement area. Looking at the maximum extension, we can get a high probability target for the session, which in this case would be the 1.4 to 1.5 standard deviation level, which has been reached 66% of the time in the past for this exact scenario. The yellow window represents the time where most of the retracements will likely happen. The red box is where most of the retracements reached into, and the red line is where 50% of retracements are done. The green box represents our target, which has been met 66% of the time in the past. Lastly, you also have the minus 0.3 retracement level that's been reached around 70% historically. You can cover that as well if you want, but for the retracement areas we went with the highest two clusters. The setup would look like this with clear targets and the retracement time for most of the retracements being over. Now it's past 12:15 p.m. and more than 50% of retracements are done. We can assume that this is the highest retracement after the confirmation has happened with a higher probability. What's happening here? Would you be scared of holding your position? Of course not. Price just rebalanced an open magnetic whip. A quick look at the tick grid also shows a beautiful divergence right here while it's reaching for the upper extremes. If you don't know what I'm talking about, watch the video where I explain the tick grid indicator. This divergence in price versus tick combined with the rebalance of the open whip should give you the confidence to hold on to your target, which is also supported by historical data. The session comes to an end and the target has been met. This is how you stack confluences in your favor. Always be prepared and ahead of the game. There was literally no excuse to not take this trade even without data. Number 3, light crude oil futures market, Monday regular DR session trade. Oil started its week with a false session in the ADR by confirming into both directions. The ODR then expanded to the upside, reaching almost 1 standard deviations after its long confirmation. It's 9:30 a.m. now and the regular DR session opens with this candle. What do you already know here? The opening is above the ODR, which already excludes a possible DR downside model coming into play. At 10:30 a.m. the box has formed. The opening and closing price is equal, which makes it a gray DR box. What more information do we have here? The regular DR session box didn't extend the ODR box. All 3 DR sessions support each other with not violating the previous DR session levels. That is a very high probability for a DR upside expansion model coming into play here. 10 minutes later, we get a DR long confirmation and can look for other confluences to take a long setup. For an upside expansion model to happen, we want every session to take out the previous session's high. That makes the ODR session highs already a low-hanging fruit target, which also lines up with the 1 standard deviation level. Now here's another great detail. We have a weekly gap imbalance lining up perfectly in addition to the long confirmation and possible DR upside expansion model. At this point right here you have a beautiful setup for a potential 5R with several confluences. Your stop can cover the beginning of the retirement setup area for a potential second entry if this one fails. Another great example of a DR upside expansion model coming into play with several other confluences stacked in your favor. Number 2. Australian dollar versus the US dollar, Thursday aftermarket DR session trade. Basic DR trade on the Australian dollar using some extra confluences from the currency's futures chart. Thursday's intraday cycle started with a green ADR box followed by a long confirmation. We get a shallow retracement back into the DR and reject the closing price and IDR high several times. Those are already clear rejections for a potential long setup, but if you take a look at the currency's futures chart, you get some better insights. At the same time these rejections happened in the spot market price chart, price rejected the opening price of the ADR 3 times clearly to the tick. As a potential target, we not only have the next standard deviation of 0.5, but also an open magnetic whip in the futures price chart, lining up perfectly with the 1 standard deviation level. Entry, stop loss and target should be clear, and that's your setup. This again shows you that a quick look at the futures price chart of a currency can give you several extra confluences. And we're coming to number 1, light crude oil futures market, Thursday overnight DR session trade. Oil had a very nice start into the day with the ADR having an immediate long confirmation, shallow retracement into the IDR high, and then extending to the 2.5 standard deviations to the tick. There is also an intraday gap imbalance inside the ADR box formation, which acted as a no trespassing area later on. The overnight DR session opens at 3 a.m. with this candle dropping lower into the ADR mid-level, but immediately turns around and finds support at the opening price before closing as a green DR box with a long confirmation. If you look at the relationship between the ADR and ODR, you can clearly see a DR upside expansion model intact. Few minutes later, price retraces back into the closing price of the DR, which also aligns perfectly with an intraday gap imbalance from the ADR. Hard to catch this trade, but it would offer a great 3.6R if you put your stop loss at the beginning of the retirement setup area for a potential second entry if you get stopped out. Later on in the session, price returns all the way back to the other side of the DR and presents a nice retirement setup with not closing below the DR several times. You either place your stop loss aggressively below the gap imbalance or, like in this case, below the ADR lows. With the session coming to an end, you can close your position in profits or put your stop loss at break even and hold on to your initial target. Very nice retirement setup with multiple opportunities to execute. Thank you guys for tuning in. I am pretty sure that you gained a lot of insights which you can also backtest with historical data. Make sure to like and subscribe, and I hope to see you in the next video. We're gonna take on the world.